Let me ask you something straight up. Did you miss Micron? Because if you followed the AI trade over the last year, you probably saw what happened. Micron went from a stock many investors treated like a boring memory cycle name to one of the clearest examples of an AI bottleneck repricing. Not because the company suddenly became a social media story. Not because retail investors discovered a magic chart pattern, but because the market realized something simple. AI needed memory. A lot more memory. And once Wall Street understood that memory was becoming a constraint, the stock was no longer being priced like an old semiconductor cycle. It was being priced like a critical layer of the AI buildout. That is the lesson. The real lesson for Micron was not just that memory stocks went up. The real lesson was that every AI bottleneck eventually gets repriced. And if you want to track the next AI infrastructure rotation before it becomes obvious, subscribe to Stock Breakout, hit the like button, and drop the one AI infrastructure ticker you think Wall Street is still underpricing. Because the question now is not whether AI is still growing. The question is where the bottleneck moves next. The stock market does not just reward growth. It rewards bottlenecks. That is why Micron mattered. AI models were getting larger. Training runs were getting heavier. Inference demand was rising. GPUs were powerful, but the system still needed enough memory bandwidth and memory capacity to move data fast enough. When the market realized memory was no longer just a commodity input, Micron became part of the AI infrastructure story. That is how repricing works. First, the bottleneck looks boring. Then the bottleneck becomes obvious. Then everybody wants exposure. And by the time retail investors finally understand the setup, a lot of the move may already be behind them. That is not a criticism. That is how markets work. Retail usually finds these trades late. Wall Street starts looking at the constraint before the constraint becomes headline news. So the question today is simple. What is the next constraint? The first AI bottleneck was memory. The next one may be infrastructure, because AI does not scale only with chips. It needs cloud capacity. It needs power. It needs cooling. It needs high-speed data movement. It needs data centers that can actually handle the load. And that is where the story gets bigger. Big tech is now in a physical infrastructure arms race. Recent reports have put 2026 capital expenditure plans from Amazon, Alphabet, Microsoft, and Meta as high as roughly $725 billion, mostly tied to AI data centers, computing infrastructure, and the hardware required to support the next phase of AI demand. That is not a normal software cycle. That is industrial scale spending. That is steel, concrete, chips, power equipment, cooling systems, fiber, networking, land, and electricity. This is not just a stock story. This is a market rotation story. Nvidia was the obvious AI chip trade. Micron became the memory bottleneck trade. Now the market may be looking one layer deeper toward cloud capacity, connectivity, cooling, and power. The obvious trade may already be crowded. The real opportunity may be hiding one layer deeper. Today, I am breaking down 3 names that belong on the AI infrastructure bottleneck watch list. Nebius Group, ticker NBIS. Credo Technology Group, ticker CRDO. And Vertiv Holdings, ticker VRT. These are not guaranteed winners. This is not a buy list. This is a risk-reward watch list ranking for the next layer of the AI infrastructure trade. Let's start with Nebius. Nebius is the AI cloud capacity bottleneck play. The basic idea is simple. AI companies need access to massive GPU infrastructure, but building that capacity is hard. You need power. You need land. You need data center design. You need access to Nvidia systems. You need customer contracts large enough to justify the build-out. And you need the balance sheet or financing model to survive the capital intensity. That is why Nebius is interesting. This is not a traditional cloud story. It is a next-generation AI infrastructure story. Nebius is focused on purpose-built AI cloud capacity. The company has already announced a major Microsoft agreement worth $17.4 billion over 5 years, with potential upside to $19.4 billion. It also announced a 5-year Meta agreement that includes $12 billion of dedicated capacity and up to $15 billion of additional compute capacity across future Nebius clusters. That tells you something important. The bottleneck is not theoretical. Large customers are trying to lock in capacity before the capacity even fully exists. That is why NBIS belongs on the watch list. Nebius is also targeting more than 3 gigawatts of contracted power by the end of 2026, and the company has announced major AI factory expansion plans, including a 310-megawatt project in Finland. But this is not the safest name on the list. It may be one of the purest AI infrastructure capacity plays, but purity cuts both ways. The upside case is clear. If Nebius scales successfully, fills capacity, keeps customers, and turns massive contracts into real economics, the market may continue to reprice it as a critical AI cloud infrastructure provider. But the risk is just as clear. This is a capital-intensive build-out. Execution risk is high. Funding risk matters. Power delivery matters. Construction timelines matter. Customer concentration matters. And if AI CapEx expectations slow down, the market will not be patient with a high-growth infrastructure name priced for perfection. So NBIS is the high-upside, high-execution risk name. It is not something I would chase blindly. But as a bottleneck framework, it makes sense. If the next constraint is AI cloud capacity, Nebius is one of the names investors will keep watching. Now let's move to Credo. Credo Technology Group is the AI connectivity bottleneck play. This one is less about where the AI workload runs and more about how the AI system communicates with itself. As AI clusters scale, you're no longer talking about one server or one rack. You're talking about thousands of GPUs, sometimes across massive clusters, all needing to move data quickly, efficiently, and reliably. If GPUs are the engines, Credo is helping build the highways between them. That matters because the AI system is only as strong as the connections inside it. If the data movement is too slow, the whole system loses efficiency. If power consumption is too high, the economics get worse. If the networking layer cannot scale, the compute layer gets trapped. That is the bottleneck Credo is attacking. Credo provides high-speed, energy-efficient connectivity solutions for AI, cloud, and hyperscale networks. The company's own materials describe its AI infrastructure products as supporting high-bandwidth, low-latency connections for GPU-to-GPU communication and large-scale AI fabrics. The financial momentum is also why the stock has attracted attention. For its fiscal third quarter of 2026, Credo reported revenue of $407 million, up 201.5% year-over-year, with GAAP gross margin of 68.5% and non-GAAP gross margin of 68.6%. That is a serious growth signal, and the Dust Photonics deal adds another layer. Credo announced an agreement to acquire Dust Photonics to expand into silicon photonics and next-generation optical connectivity, including 800G, 1.6T, and 3.2T optical interconnect opportunities. That matters because the connectivity bottleneck may shift over time. Shorter distances may still use high-efficiency electrical connections. Longer distances and higher bandwidth needs may push more demand toward optical solutions. Credo is trying to position itself across that transition. That is the bull case. But again, this is not risk-free. Valuation matters. Customer concentration matters. Execution matters. Competition matters. And when a stock is already being treated like a strategic AI infrastructure winner, expectations can become dangerous. If growth slows, if margins compress, or if customers delay orders, the stock can reset quickly. So CRDO is not a sleepy infrastructure name. It is a high-growth connectivity bottleneck play. The signal to watch is demand, margins, customer diversity, and whether the company can turn the electrical to optical transition into durable market share. Now let's talk about Vertiv. Vertiv Holdings is the cooling and power bottleneck play. This may be the least glamorous name of the three, but it may also be the most important, because AI has a physical limit: heat. The newest AI systems are pushing power density to levels traditional data centers were not designed to handle. High-end AI chips and rack-scale systems are forcing the industry toward liquid cooling, better power distribution, and more integrated infrastructure design. Nvidia's B200 has been widely described as operating above 1,000 watts per processor, while liquid-cooled rack-scale AI systems have become increasingly important for high-density deployments. That is where Vertiv comes in. Vertiv is not just an industrial stock. It may be part of the thermal backbone of the AI economy. The company provides critical digital infrastructure, including power management, thermal management, liquid cooling, monitoring, and services for data centers. And the numbers show why investors are paying attention. Vertiv reported first quarter 2026 net sales of $2.65 billion, up 30% year-over-year, with 23% organic sales growth. Before that, Vertiv reported that fourth quarter 2025 backlog increased to $15 billion, up 109% year-over-year, with a book-to-bill ratio of roughly 2.9 times. That backlog matters. It suggests demand is not just a story. It is showing up in orders. And unlike a pure growth stock, Vertiv has a more established business base. It has customers, service relationships, field infrastructure, and a physical product ecosystem that becomes difficult to replace once installed. That is what creates sticky revenue. If a data center installs power and cooling architecture around a vendor's system, it is not easy to rip it out overnight. That is why Vertiv is so important. Without cooling, nothing works. Not the GPUs, not the racks, not the servers, not the AI model. The market used to see Vertiv as an old-school industrial company, but the AI build-out may be turning it into something different. A physical infrastructure compounder tied to cooling, power, and data center density. Still, the risk is real. Vertiv has already been discovered by the market. The valuation is not hidden. Expectations are high. If hyperscaler CapEx slows, if data center orders normalize, if margins disappoint, or if investors start worrying about an AI infrastructure overbuild, VRT can fall just like any other crowded AI trade. But among the three names, Vertiv has the strongest mix of established operations and direct exposure to the physical bottleneck. Now let's compare them. NBIS is the cloud capacity bottleneck. It has the most direct exposure to the AI cloud build-out, and it may have the highest upside if execution works. But it also has the highest execution risk. CRDO is the connectivity bottleneck. It is the cleanest pure play on data movement inside AI infrastructure. If AI clusters keep scaling, connectivity becomes more important. But valuation, customer concentration, and competition are serious risks. VRT is the cooling and power bottleneck. It is the most established business of the three. It has real infrastructure exposure, real backlog, and a clear role in the physical scaling problem. But it is not cheap, and the market already understands a lot of the story. That is the framework. Capacity, connectivity, cooling, and power. Three different layers, three different risk profiles, three different ways to think about the next AI bottleneck. Now let's be serious about risk. Not every AI infrastructure company is a buy at any price. Valuation matters. Execution matters. Customer concentration matters. AI CapEx can slow down. High-growth stocks can fall hard. Crowded trades can reverse quickly. And when Wall Street starts pricing a company as a winner before the results fully arrive, the margin for error gets smaller. Nothing in this video is financial advice. I am not your financial advisor. This is market commentary and research for education. The goal is not to chase every stock with AI exposure. The goal is to understand where the bottleneck is moving. Because if Micron taught investors anything, it is that the market can ignore constraint for a long time, then suddenly reprice it very quickly. Now here is my risk-reward watchlist ranking. Number 3 is Nebius, ticker NBIS. NBIS has the highest upside potential, but also the highest execution risk. If Nebius converts major contracts into profitable capacity, the market may continue to view it as a serious AI infrastructure platform. But this is a heavy build-out. The company has to deliver power, data centers, hardware, customer capacity, and economics at scale. That is a lot to prove. So NBIS is number 3. High ceiling, high risk, not a name to chase blindly. Number 2 is Credo, ticker CRDO. CRDO may be the best pure-play connectivity bottleneck. If GPU clusters keep getting bigger, the highways between the GPUs become more valuable. Credo has strong revenue growth, strong margins, and a strategy that reaches from electrical connections into optical connectivity. But the stock already carries high expectations. Valuation and customer concentration matter. So CRDO is number 2. Strong bottleneck exposure, but not without risk. Number 1 is Vertiv, ticker VRT. VRT has the strongest mix of business quality, AI infrastructure exposure, cooling demand, and physical bottleneck relevance. It is not the most exciting story. It is not the purest AI cloud play, but it sits directly in the part of the AI build-out that cannot be skipped. Power, cooling, thermal management, data center reliability. If those layers fail, everything above them fails. That is why Vertiv takes the number 1 spot on this watchlist ranking. Again, not as a buy call, as a risk-reward framework. Micron was the memory bottleneck, but AI does not stop at memory. The next bottleneck may be capacity, connectivity, cooling, and power. And that is where the next market rotation may be forming. The danger is not just missing the first trade. The danger is missing the pattern. If you want to follow the next AI infrastructure rotation before it becomes obvious, subscribe to Stock Breakout. Hit the like button if this breakdown helped you. And drop your strongest ticker in the comments. Is the next bottleneck cloud capacity, connectivity, cooling, or power?